Hi, this is Matthew Cratter from Trader University, and today I want to talk about candlestick charting for beginners. If you're just learning about the stock market, if you want to learn stock trading strategies that actually work, or just want to see what I'm investing or trading, be sure to hit that subscribe button. So here we have a classic candlestick chart. This is on tradingview.com. It's a free service that you can use. Most of the functionality is available for free. You can see I'm looking at a chart of Amazon here, AMZN. These are daily bars, which is what the D means up here. You can toggle between different time periods. And then the way you get a candlestick chart is this little icon right here. You can toggle between bars, bar charts, candles, etc. So I'm going to be clicking candles. And this is what a candlestick chart looks like. Now you'll notice the first thing that really jumps out at you are these two different colors, red and green. There are different ways you can configure this on TradingView, but I like to use it this way. Now, the colored part is known as the body. This is the body of the candlestick. And then you have these little lines that go above and below. These are known as the shadows. Sometimes people call them the wicks, as if you're talking about an actual candle. And we'll start with these little lines that go above and below. They're the easiest to understand. These are basically just the highs and lows of the day. So these are daily bars. That's the high. That is the low. And then what's called the body, this middle part, is measures where the market opened and closed. In this case, the market being Amazon stock. So if the bar is green, if the candlestick is green, what that means is that you opened here at the bottom of the body and you closed here. So this is the close, this is the open. And you can think of it as being green because the market went up from the open to the close. Now in the meantime, it negotiated a low right here and also negotiated a high. And so I really like candlestick charts because it allows you to very quickly visualize whether the market opened or closed higher than it opened or closed lower than it opened, as well as the range for the day, the trading range, that sort of high to low. So a green bar means you opened at the bottom, you closed at the top of the green part, what's called the body. A red bar would mean that you opened here and you closed down from the open. Now in the meantime, you had the same sort of thing going on here. You had a high at the top of the wick or shadow, and then you had the daily low at the bottom of this wick. So very easy to remember. If the market closes lower than it opened, you get a red bar. If the market closes higher than it opened, you get a green bar. Now the last thing I need to point out is some of these weird candlesticks. These are called dojis. Here's a very good example right here. They look a little bit like a cross. All the terminology here comes from, this was invented by the Japanese, I believe the Japanese rice futures traders many years ago. And so you'll notice a lot of the terminology is Japanese words. A doji just means that the open and close were the same. So it opened where it closed. These kind of candlesticks do not have a body. And they often show some real indecisiveness. So if we go back to that first chart, we can see that we got a bunch of dojis right here. And this marked a turning point in an uptrend. The market had been trending, or the stock had been trending up until this point. We got some indecision as measured by the dojis, where the close and open of the day are the same. And then that proceeded to set off a sell-off the next in the coming weeks. So that's one thing that a doji can indicate. So again, red bars, green bars, dojis. Now let me show you how to use these. This is where it becomes really interesting. And the first formation, there are many different candlestick formations. The first one I'm going to show you is called the hammer. And the hammer is just what it sounds like. The hammer, you can think of it as hammering in a bottom. So a hammer will occur, or it's most significant when it occurs at the end of a downtrend. So you have a sell-off, and then you get a hammer. The hammer is right here. I'm going to actually scroll in a little bit more here so we can see it. Okay, so a hammer has a long lower wick, and then it's got a smallish body usually that it's at the top. So this long lower wick can be considered to be, it's like the handle of the hammer. and then the part that you actually hit nails with is the top part. So you can think of this as hammering in a bottom. It's a bottoming formation. It occurs, as I said again, at the bottom, at the end of a long downtrend. And it can be, and again, you can look at these charts. You can use a daily chart, you can use a weekly chart, you can use intraday charts like maybe a 15-minute chart or a 10-minute chart. You can obviously toggle here between the different time frames. But a hammer formation is a good way of trying to catch a bottom in a stock after a sell-off. And what you can do is you can go long on the close of this day, which I guess would actually be right at the bottom here, the red thing. You can go long there, and you can set your stop at the bottom of the hammer. That's a really natural place. If the market trades below that, or if the stock trades below that, or if it closes below that, those are the two ways of thinking about it. That means that you were wrong and it was sort of a false bottom. But why does this work? Well, what happens is the market makes an excursion into lower prices. And it makes sense. The market is testing the bottoms, trying to find a bottom. And so it keeps selling off. But what happens on a hammer day is the market sells off. It basically opens, it goes way down to the bottom of this shadow or wick, and then it closes near the top of the range. And what this shows you is that there are a lot of buyers down here, and the market wasn't able to stay there for very long. And that's one reason that this works. So again, this is the hammer candlestick formation. Now we're going to look at the inverse of this, or the mirror image, and that is called the shooting star. Shooting star obviously is a great name for it. I don't know what the Japanese name is, but a shooting star shows that something is falling, like a meteorite, etc. And this is very, very much the mirror image, as we said, of a hammer candlestick, where you have a very long upper wick or shadow. The body is confined to the lower end of the trading range. And this is a sign that the market tried to move higher. In this case, this is Gap Stores. GPS is the ticker. There was an earnings report, as you can see right here, when the market closed in the afternoon after the market was closed. The stock gaps up the next morning, and things are looking very good for a while, but then the stock settles at the lower end of its trading range, thus providing this really long upper wick and creating the shooting star formation. And what this means is that higher prices were rejected by the market. It was unable to, a gap is obviously very bullish, but if you see this sort of bearish action where the market's unable to move higher during actual trading hours, that can be a bearish signal. And so you get price rejection by sellers at these higher levels. The market still closes up. This is a fairly significant gap, but you can see that this was definitely a bearish indicator. So we know that hammers are bullish indicators. The mirror image shooting stars are bearish indicators, and it was a really nice short for the next 2 weeks, next 10 to 14 days. Now, very similar to a hammer, where we went long on the close, you can actually go short on the close. You could short it right here and size it such that you can put a stop loss right up here. So what I would do is maybe I would risk 1% of my account, and I would calculate how many shares that would be. And if the market traded or closed above the top wick or shadow, I would know I was wrong about my bearish position. Now, one thing we didn't talk about when we talked about this first chart was the different kinds of bullish and bearish candles. So a good example of a really strong bullish candle would be one of these really long green bars, as we see here, where you essentially, it's got very few wicks or shadows on the top or bottom. You basically closed at the bottom. You opened in the morning at the bottom, and you rallied the whole day, and you closed at the highs. So that would be a very strong candlestick. As we said, doji candlesticks are a little bit more indecisive. They can mean the end of a trend. They can mean the market, basically it shows the market's not really going anywhere for that day. It's unable to make progress up or progress down. And so a green doji, where there's just a tiny little body like that, is obviously a fairly weak signal, unless you get a lot of them at the end of a trend. A sort of less bullish, but still bullish candlestick would be a candlestick like this, where it's a green candlestick. It looks a little bit like a shooting star. The wick is not quite as high, But this isn't super bullish, even though it has a green body, because it has this long upper wick. And so what you want to see is a very long and strong body, as you're seeing with this candle right here. We can scroll in and look a little more closely at this. This was an interesting candlestick. So this is the same chart we were just looking at, where you basically had a gap, a daily gap right here. There's a space in the chart. And what happens on this day with that very strong green candlestick is you fill that gap and you close decisively above it. Now this happens after you've been in a period of sort of low volatility. You can see especially the days, we had two dojis here in the days preceding it. The dojis were inching to the top of the trading range, but then you get a decisive break up, a break higher, and this is a good sign that it's time possibly to go long. So you can go long, you can buy Amazon stock on the close here. Maybe you set your stop, at the low of that candlestick, and then you just ride it for a couple days. This would be a way of using candlestick charts for a swing trade, and you ride it until you start to see either a long upper wick, as you got here, or some dojis, very kind of indecisive days. And you can see basically this is the way markets move, where markets are either trending or going sideways depending on the time. And markets and charts have fractal properties where you can really look at this on any time scale. You can look at daily bars or intraday. In this case, we're looking at daily bars, and you basically have a strong move higher, and then the market enters into a sideways consolidation mode, which you can tell by a trading range that is respected, along with lots of dojis within that trading range. So that's basically how candlesticks work, and there's a lot of variation to these. There are a lot of different formations you can have. You can actually go really deep into candlestick charting, price action trading. If this is something that interests you, that you found helpful, you can check out my online course on price action trading, where I have multiple lectures on all these different formations that you can get, and some of them have very cute names like bearish abandoned baby, bullish abandoned baby, island reversals you may have heard about. And so I go into a lot of depth here, looking at chart formations. Some people call this naked chart trading, where you're not using any indicators. You're just learning to read the price. But if you're just getting started in the markets, this is a really good place to start and to learn how to trade just price action, not worrying about moving averages or Bollinger Bands or RSI or anything like that, but learning how to look at a chart and derive as much information from it as you can. In addition to this price action trading course, I have tons of other courses. If you want to learn how to trade options, swing trading with options, if you want to follow my crypto and Bitcoin investments. And then another one that people have been finding very helpful is bear market trading strategies is good in this environment. Now, the good news is you don't need to choose between one of these. You can get all of them for one low monthly price, unlimited access to all 13 courses. So if this is something that interests you, you can check out you can click on the description notes below, click on any of these courses, and it will show you the curriculum, the list of lectures. And then if you'd like to subscribe, you can scroll down to this button, click Get It Now, and that will take you to the checkout page. Now, normally tuition is just $125 for 30 days access to all 13 courses. But because we're currently in a recession, I'm going to give you guys a better price. So if you scroll down on this checkout page, click have a coupon code and type in YT, as in YouTube 99. That's going to shave $26 off. So the price, instead of being $125, will be just $99 for 30 days access. There are no long-term contracts or anything like that. So you can watch all the courses. You can do a really deep dive into price action trading, candlestick trading, swing trading with options, all the courses, take some notes, and then cancel before it renews, and you won't be charged again. So if you're stuck at home, you're tired of binging on Netflix, this is one productive way you might consider using your time. You can also check out all my free videos on YouTube as well. Please hit that subscribe button if you found this helpful. Hit the like button as well, and let me know your questions and comments, especially suggestions for what kind of future lectures you would like me to make. Leave those in the comment section below, and I look forward to interacting with you guys there. Hope you're all staying well, and I'll see you in the next video. Thanks a lot for watching.